All right, good morning, everybody. Love to see you all here bright and early. My name's Felix. I'm the host of the Forward Guidance podcast at Blockworks, which is a podcast that focuses on the intersection of macro and crypto. So that will be the conversation of this morning. Excited to be joined today by Quinn Thompson, CEO and founder of Lecker Capital, and Michael Howell from Cross Border Capital, and the maven of all things liquidity and how that works into the world. So excited to have you both here.
Great to be here.
Yeah, it's a privilege to have you, Michael, because when it's Tyler with us, they put us in the furthest back room because it's such a cancel risk when we do this live. So we got upgraded.
I have to say I'm a great fan of Forward Guidance, and particularly the Friday wrap. So I think everyone's got to tune into that. It's really good with these guys, and Tyler too. Appreciate
that a lot. Michael, for those that aren't familiar of your work here that are tuned in and listening, we'd love to just get a bit of background on what is your macro framework? How do you think about global liquidity? And what are some of these key drivers that you look at? And why has that taken such a hold of, you have quite a following now these days, especially in the crypto world, because of those marginal drivers of liquidity. So what does that framework look like?
Okay, maybe let me start at the beginning. I originated at Salomon Brothers, the American investment bank. Salomon Brothers, for those of you who don't know, was the world's biggest bond trader worldwide. We had big proprietary desks, traded bonds all over the world, and really understanding the fixed income markets kind of meant understanding credit flows, money flows, capital flows worldwide. So I was on the research side, and what we did is put into place a framework for understanding those money flows worldwide. And that's pretty much what I've run with ever since. It's really understanding capital markets means understanding where the money is, where the money's flowing. And that's pretty much what we do. So we came up with this concept of global liquidity. That's what we monitor. We now, at Cross Border, basically monitor 90 financial systems worldwide on a monthly and sometimes a weekly basis. And we come up with aggregates and measures of these global liquidity flows. And I would say they work. I mean, I suppose I wouldn't be here if they didn't, but they sort of work. So really understanding that dynamic is critical for understanding asset allocation worldwide. What drives markets is not textbooks, it's money flow.
And so where are we in the global liquidity cycle? What's going on?
Well, I mean, the short answer is that we're in a strong upwave, and we're probably nearing the top, okay, of the cycle. And I'm going to stress that we've got a cycle and there's a trend, and the trend is probably a lot more powerful, and that trend, which I think courtesy of JP Morgan have been called the sort of monetary debasement trade, that everyone is now jumping on. And that is real. A colleague of mine was at the LME conference this week talking to a scrap metal dealer, a precious metal metal dealer, who's been in the business 35 years. He said normally, with a spike in gold bullion prices that we've just seen, you will see a lot of new supply coming from second-hand gold. He said, I've seen none. No one is trading in their gold. So what is going on is people are understanding that governments, thank you very much, are debasing paper money. That's the trend that we're looking at, and that's eye-wateringly scary. Okay. The other thing is a cycle, and you've got a cycle on top of that trend. We're probably coming towards the end of that cycle. I would imagine it may be months or maybe a couple of quarters away, and we've got to be alert to the fact that it may be coming down. And one of the reasons that it could be coming down is probably two or three things. One is that central banks get scared. Okay. Listen to what Jay Powell was saying last night at the Fed. He was saying, look, we're getting now tensions in repo markets. Liquidity is starting to see strains in the US system, and therefore we're going to change our policy maybe a tad. But there's only so much he can do. And one of the reasons you're getting a pickup is that maybe the US real economy is starting to accelerate now simply because there's been so much money thrown at it by the administration and by CapEx in AI, etc. So we're somewhere near the top of the cycle, but the cycle's been with us, bullish cycle since October of 22.
It's an interesting thing about the liquidity cycle starting to top out, because we were talking backstage. Quinn, you're mentioning how you kind of feel like we actually had this recession. It's interesting. It feels like nonstop since 2021. There's been calls for recession. We've had moments where 100% of economists were calling for a recession, and it didn't happen. And a lot of that is characterized by this K-shaped economy that a lot of people have been talking about. But you're of the mind that that's already kind of happened, and we're actually coming out of the trough and into a reacceleration. What does that look like?
Yeah, earlier in the year, Q1, when we were talking about it pretty bearishly on the policies of the Trump administration and what those feed through into the economy, cutting immigration off, increasing tariffs and reducing trade, serious growth headwinds, cyclical growth headwinds, because by the time we're a year from now, those base effects already rolled off. And that was at a time when, in 2024, really going into the presidential election in November, every bell and whistle was utilized to keep things afloat. And the data is now showing through the BLS revisions and other labor and backdated things that we really have been in a recession in the US, at least a Main Street, maybe not the AI sector, but a Main Street recession since early 24. And we're now 7 months past these dramatic policy changes in the US, and the market boogeyman has not persisted or reared its head again. And one of the fascinating things is why it's so bifurcated in the views is because when gold does what gold has been doing, this is a crisis type signal. It's a economic calamity, like huge problem. And what we don't see from a nominal basis, because all asset prices are going up, is that it has been smoothed over by manipulation of government debt issuance, Fed pressure, and liquidity. And so we've actually, bolstered things. And so when you look across the landscape now, there's a lot of signals that the economy is reaccelerating in the US. Going into the midterms of 2026, you can't have Main Street in a recession if you're looking to get reelected as an incumbent. And every single asset price is at all-time highs. Stocks, gold, bond prices are at 12-month highs, yields 12-month lows. Mortgage rates are at 3-year lows in the US. And it's very difficult to fight that from a next 3-6 months perspective, because especially in an environment where 50% plus of the consumer spending is driven by wealthy asset owners. And so I think we are entering this period where I've been very open with my critiques of different policies, but they have sort of threaded this needle in the US that sort of bodes well for them. Inflation is way higher than 3%, and there's a cost to it long term, socially and economically. But from a nominal basis, it's been smooth.
Michael, what does that lead-lag relationship look like between a classic business cycle characterized by GDP growth that Quinn was just mentioning and your global liquidity cycle? Do they lead? Do they lag? Is there any times where they're coincident? Like, is it normal to see this dynamic where it feels like liquidity is topping out, but perhaps economic growth is actually just starting to reaccelerate?
Yeah, absolutely. I mean, they're completely out of sync. I never use the economic cycle for asset allocation. I think it's never worked for me. I don't think that really matters. GDP doesn't matter that much for markets. What really matters is money flow. And if money is in the real economy, it's not in financial markets. If it's in financial markets, it's not really in the real economy. And what I'm interested in is where the money is in financial markets. And therefore, if you get a strong economy or even a pickup in inflation, I can kind of see that as a negative in terms of the outlook for asset markets. So in that regard, liquidity is a leading factor. It tends to lead economies by about 12, 15 months. Why? Which is why I think Quinn's point about maybe a US economy accelerating into 26 seems to me pretty plausible, because liquidity has been building up for quite a long time now. So why doesn't it spill over? It certainly should be. And maybe that's what we're seeing right now.
Mm-hmm. And that's, to just touch on that, it's why there's such disagreement or unsettlement across the financial markets and industry with central banks' actions, because the central banks were created to stabilize the economic cycles and come in when things are too hot and suppress, when things are too low and boost. We're seeing a world where they're super pro, they're just pro. It's just boost at all times, and that's what's causing this inequality.
Yeah. To that point, Michael, you mentioned earlier that there was a speech yesterday from Fed Chair Jay Powell where he mentioned that they're likely to begin to end quantitative tightening and that there are some of these hiccups in the funding markets. And it looks like, they're going to pretty quickly shift to no more QT. It's interesting to think about shifting into the perspective of how crypto market participants think about all this liquidity stuff. Last major crypto cycle back in 2020, 2021, everybody started to understand the game of QE, monetary QE, and I was like, all right, well, we're doing this, we're doing a ton of quantitative easing. That's obviously bullish for markets. And ever since then, there's been this obsession with, okay, we need the QE so that we can go higher. But the fact is that we've actually been in the complete opposite. We've been in QT, and we've had Bitcoin all-time highs multiple times throughout that time. So I'm just curious if you could unpack, like, how do you think about, you've talked a lot about Treasury QE as a different function of that. And so when you look at some of these drivers of liquidity of funding markets, what does that tell you versus that previous cycle where the obsession was for monetary QE?
Yeah, it's a great point. I think that the first thing to say is there has not been QT in the US despite the headlines. I mean, that's very clear. If people believe that the Fed has been taking liquidity out of the system, dream on. It hasn't. It's been injecting a lot through various, underhand means, let's say. But there's very clearly been a big liquidity uplift in the US over the last 2 or 3 years. That's for sure. It may well be, as I alluded to, coming to an end because they kind of run out of road of these sort of secret, packages to put in. And what you're getting now is maybe a shift into what I've dubbed Treasury QE, and that is effectively shifting issuance from the calendar, from the long end of the market to the short end through Treasury bills. But I think the idea that the administration has is what they're going to do is use that to direct it into the real economy. So rather than sort of spraying the hose everywhere, they're going to just direct it through the bill market, or funded by the bill market, into the real economy in terms of defense procurement, maybe more capex in terms of AI, buying strategic resources or strategic stakes, all these sort of factors. So I think there's a difference in complexion. That transition may worry the financial markets because it means that bank reserves could be depleted. And that's what Jay Powell was talking about last night when he was alluding to tensions in the repo markets. So you've got to watch that. I mean, there's no question about that, okay? But I think the other thing I'd say from a general perspective to answer Felix's question, we did a deep dive into what drives crypto, and we did an analysis, statistical analysis, of looking at data, weekly data, from around the end of 2016 onwards. So you've got quite a long sample there. And what we found was that the main driver of Bitcoin is global liquidity. About 50% of the systematic influences on Bitcoin come through global liquidity. So that's why everyone's very interested in QE or QT or these sort of factors. Now, what I stress is global, because you've also got another huge player out there, China, which I'll come on to. The other two factors that are kind of interesting are that around 25% of the movement in Bitcoin is kind of risk appetite elements. So you might associate that with NASDAQ or tech stocks or whatever. So if tech goes up, Bitcoin, crypto will go up. If NASDAQ and tech go down, then they're going to take a hit that maybe other monetary inflation hedges like gold wouldn't necessarily. And then the third element, which is another about 25%, is the gold price. Now, if you look at the gold price and the relationship, it's really quite interesting from a statistical point of view, because what you find is that Bitcoin and gold are negatively correlated in the short term. So in other words, if Bitcoin goes up, gold tends to languish or come down. And if gold goes up, Bitcoin seems to languish or go down. Does that sound familiar? But in the long term, they catch up. So in other words, what you'd expect to see now is the big spike in gold is going to elicit another move in Bitcoin, positive one, okay? So you've got these three moving parts which make it kind of a little bit more complicated, but those are the things you've got to watch. Now, I said that this is a global phenomenon, so you've got to think about global. And China is easing massively right now. So if you look at what the PBOC is doing, PBOC has injected in the last 12 months about $1 trillion US, so about 8 trillion yuan, into their financial markets for the first time in a long time. So they're starting to get out of this sort of tight monetary regime that they've basically been they've imposed on themselves over the last 4 or 5 years. That is a big change. Evidence that, look at the Shanghai stock market, look at the bond market in China, yields are rising, term premium are rising, it's basically there. And the reason, which I'll allude to maybe later, is I think they perceive a whopping great threat to the integrity of the Chinese system from stablecoin.
Quinn, I'm curious, you've been doing a lot of work on looking at gold as the signal, as the canary in the coal mine right now, because Bitcoin could be that, but on a short term, you get these leverage washouts that we just had over the weekend, which makes the chart just look brutal on a short-term basis. But eventually it gets there. But gold has been quite the signal, and we talked about this earlier about how the debasement trade, if you look at the Dixie, if you look at the US dollar, it's actually been quite flat in recent months, even though this idea of the debasement trade has been taken hold. I know you've been looking a lot at gold in terms of comparing it to other asset classes, in terms of a relative ratio. How do you think about that analysis?
Yeah, there's a high and growing level of angst and anxiety in crypto right now amongst investors for two reasons. One, it's incredibly hard if you've been in the industry to part ways with 5 to 10 year established biases around this 4-year cycle that most still prescribe to and believe in. And really since January 2024, when the ETFs put Bitcoin on the global stage, it has become a completely different asset class that is unrecognizable from what it was before in many characteristics: max drawdown, volatility profile, max upside within a short amount of time. But many are still clinging to this 4-year cycle, which I believe strongly. My highest conviction view is that is over. And secondly is, so we're right at the tail end of when the normal 4-year cycle would end, so people are very angsty. And the second is, oh my God, after this liquidation on Friday, Bitcoin just touched the price that it was at in December of 2024. This was a period of peak exuberance. Trump's going to do everything, strategic Bitcoin reserve, etc. And we're still there 10 months later, despite gold having done plus 50% year to date. And it's an incredible amount of consolidation for an asset that is rather explosive. And part of that has been the distribution of long-term holders into this level. And I posit that we will catch up to gold. It will start very soon. And the move that is about to come in Bitcoin and crypto broadly will resemble a November 2024 and an October 2023 type of move. And this liquidation reminded me of August 17th, 2023. I remember because I was getting off a plane in Greece on vacation and checked, and it was a similar liquidation event. And I was extremely bullish on the macro and super excited about it. And after that event, we doubled in 4 months. And I think it tends to be like that, where you get the shakeout before the big move. But truly, the amount of liquidity, I think, to Michael's point about what drives Bitcoin's price being this global liquidity, everybody has different methods of looking at it. And some people look at the Fed facilities, the RRP, interest rates, balance sheet, these things. But it's very important to incorporate some level of market-based measure into that, because when you have stock prices globally at all-time highs and moving higher, you have bonds very supportive, everybody's extremely flush with cash, it's very difficult to break that upward momentum, particularly if you remember in 2021, what ended things was the removal of the punch bowl, flat out. That bubble was a bubble because the Fed was stimulating far too long into the economic recovery. And in this case, we're moving into a situation where things feel very weird. Asset prices are very expensive relative to historical norms. But we are moving closer and deeper towards and into the punch bowl before May of 2026, when Powell gets replaced. So it truly is unprecedented times.
Yeah. Michael, I want to double click on something you mentioned about stablecoins. That was quite the quick little comment you had there, but I think it's really important. Curious, how do you think about it? You mentioned that China sees it as a systemic risk to their sovereignty in some ways. And then there's also this dynamic of stablecoins in terms of, can it be that next funding mechanism for just the amount of debt that we need to issue? You mentioned earlier about how one of the key strategies is tilting a lot of treasury issuance towards bills. Stablecoins are collateralized by treasury bills. How does that whole dynamic work, and where do you think that goes?
Yeah, great question. Just to, maybe before I answer that, just to pick up on something that Quinn said, I think another way to think about this whole regime of where Bitcoin and crypto fit in is that we're in the commodity phase of the cycle, the investment cycle right now. That's what's really moving. And that's synonymous with getting towards the peak. So I think all these things are kind of consistent. But where does Bitcoin fit in? I would say it's probably reflects about 1/3 tech stock and 2/3 commodity. So you're going to do better in Bitcoin than in tech if that's where your investment focus is. So think of it in those terms. Now, to come back to the stablecoin question, I wrote a book about 5 years ago called Capital Wars, which was trying to make the point that whatever the skirmishes on trade, what really matters, the big battleground, is capital, control of the world's capital and capital flow. And it's really between, obviously, no surprises here, America and China. And it's really about the development of a financial system, which is really going to effectively collateralize money in those two regimes. I think the US is moving more and more towards some sort of digital collateral in some form, whether that's stablecoin, repackaging treasuries through stablecoin or whatever. But I think that's the move. So digital is really ultimately collateralizing the dollar system. What China is doing is collateralizing its system through gold, and I think that's the alternative. So you've got these two very different financial systems. And what has really spooked China, in my view, I mean, I may be completely wrong, is stablecoin. The Europeans flagged this by saying, this is a great threat to our monetary system because Europeans can basically, disintermediate out of euros. We lose control and they go into the dollar system. But that's a big threat for China. So if you're a Chinese exporter accumulating cash, you've got a choice. You can currently put your money in the Western banking system. Well, kind of good luck there because you might get it sequestrated like the Russians did. Or you give it to domestic Chinese banks. Well, good luck there if you're like Jack Ma and fall out of favor with the PRC, then you've got a problem. So why not put it into stablecoin, which presumably has got some anonymity and you've got some protection there. So that may be a huge threat to the integrity of the Chinese financial system. They could see capital flight through that mechanism. And the one thing that the Chinese are already scared about is capital flight and losing control. So I think this has urged them into trying to make their financial system more robust all of a sudden. And this explains why you've had this big surge of liquidity going into the markets. They want to try and get rid of their debt problem. If you look at the parallels through history, if you've got a big amount of debt, the only way you get out of that is not by defaulting, because you can't, because that is the collateral in the financial system. You've got to devalue paper money. And that's what they're trying to do. So my view has been that they're trying to devalue the yuan against real assets, read devalue against gold. So the yuan gold price is really driving the world gold market, and that's what we've got to start thinking about. Now, what China has done so far is to put $1 trillion equivalent into their monetary system. To draw the parallel, America did 2.5 after the GFC. So China's got to do something similar to that. Japan is a role model. Japan did the same 15 years earlier. And look at what Japan has done, devalued the yen massively. But it's not against the greenback that we've got to judge the yuan. It's against the gold price. And that's really the key thing to think. And if you extrapolate long term, I mean, we can get onto the mechanics later, but my view is that you've got two big forces now that are effectively pushing up or devaluing paper money and pushing up gold and crypto. One is China and one is the US. And if you do some extrapolations by saying that the real gold value of US debt is going to remain constant from here, the skyrocketing amount of debt tells you that sometime in the mid-30s, gold is going to test over $10,000 an ounce, and by 2050, long after me, it'll be $25,000 an ounce. So think what Bitcoin could do in that time frame.
That actually, I hadn't heard your full explanation of the China concern about stablecoins, but it tracks really well. Dating back to 2021, they banned Bitcoin mining, and some of this in this room might be aware of that, but the big thing there was it was the most efficient and easiest way for capital flight to convert yuan to Bitcoin and instantly and send it globally without going through their banking system. Just invest capital on the ground into Bitcoin mining equipment, and there you have it. And it tracks very, very well. They're very aware of that, and I can totally see.
It's so interesting. It feels like there's two levels to this U.S.-China thing. There's the tariffs versus rare metals constraint and fight, and then there's this one that we just characterized, which is gold and stablecoin slash Bitcoin. Do you guys see it that same way, where there's this like there's the traditional version of that, which is terrace metals, and then this new one, which is what are we collateralizing the system with?
Yeah, I think so. I mean, the big issue for me is the capital war element. That's where you've got that's where most of the fighting will take place. And I think in terms of the trade war, I mean, they'll do a deal. It'll be cosmetic, and ultimately there'll be some rejigging of supply chains for sure. But ultimately, it's about control of capital.
I completely agree. We are in a conflict globally. I mean, there's clearly it's becoming multipolar and these axes of power, and we're just in a world where the developed world's appetite for human death and loss of life is diminishing. Maybe that's one good thing of social media. Many bad things of social media, but it is exposed some of the real catastrophes of physical conflict. But it is so true that everything globally right now is a financial capital war. It is severely the case.
Yeah. So of course we are talking about all of this in London, in Europe. We haven't talked about where Europe sits in all of this yet. It's an interesting situation. You have, of course, this union where you have a common currency, but then fragmented bond markets. A lot of these bond markets, their long bonds, have been selling off like mad. We've seen gilt sell off. France is struggling pretty hard right now, and then you see the fallout of that from the political spectrum as well, where you have a lot of political instability. Michael, you're from London. You know Europe very well. How do you think about where Europe fits into all of that with the context of this common currency but fragmented bond markets?
Well, the short answer is badly. I mean, there's no question that it looks terrible. I think the world is, one has to go back to, looking at George Orwell in 1984 and sort of thinking, how prophetic he was. And in that novel, you'll note that Britain was airstrip 1, so it was just the landing ground for Oceania, which is basically America, Australia, etc., in terms of their attacks on Europe. Now, the fiscal situation here is dire. There's not much they can do about it, really, without reneging on welfare promises. The deficit is clearly escalating. They can't get it down. We're overtaxed. We're in the wrong part of the Laffer curve. And the only thing they can do is allow sterling to be crunched, and that's what's inevitably going to happen. If you look at Europe, I mean, Europe has a big problem. And the issue is that Europe tends to extend its frontier in terms of institutional frontier through crisis. And what they need is a crisis so they can basically have a European bond market, in other words, with a euro-denominated bond. And the problem they've got at the moment is that there's no safe asset in the euro system, apart from the German Bund. And that means that if you get a crisis, everyone goes into the Bund. And despite Germany's problem, it's still the cleanest shirt in the European laundry. And so what happens is that bond spreads blow out. So there's absolutely no way you could get a sort of a stable coin really being issued in Europe while you've got that fragmented bond market.
Yeah, I think one thing us Americans always get crap for is maybe saying it like it is a little more bluntly. And I think the problems that really developed nations globally are facing population decline and how rapidly that's being offset with immigration, inflation problems, wealth inequality. They're really quite the same when you look at UK, US, Europe, and to Trump's credit is he has kind of hit it on the head and said it how it is. And the thing that's really carried the US through this economic malaise since 2024 globally is our AI industry and having the Mag 7 attract the global capital flows, which if you look at a long dated chart of dating back 100 years of U.S. equity premium to global equity indices and then U.S. dollar relative to global fiat currencies, they're almost 1-to-1 correlated. U.S. equities are really levered U.S. dollars, and having that kind of global attractive asset in Mag 7 has really supported the economy in dollar. But it's bleaker, I think. All fiat is bad, but yeah.
Well, I mean, it's so interesting too. Just that bleakness. You can feel it in society right now. This chase for the debasement trade. Suddenly, everybody's talking about there's this panic you can feel within people where it's like, I need to be invested in something. I need to be invested in something fixed and real, like gold, like Bitcoin, like, even collectibles. Pokemon cards are going crazy these days. It's just like anything that they can't print. And Michael, you actually had some really interesting research a couple of weeks ago where you were doing some regression analysis on gold versus fertility rates and how that cross correlates with housing affordability and household formation. And I would love to just hear your thoughts. We talk so much about market price action and, okay, we need to own Bitcoin and gold to have the life raft out of here throughout this bleakness. But walk me through like the societal impacts of that.
Yeah, well, that was a sort of somewhat tongue-in-cheek analysis, but it was basically just working out the sort of correlation or negative correlation between a rising gold price and falling fertility rates. And that's what you've seen across the West. And generally the connection is that the house price to income ratio tends to spike upwards when you've got a lot of liquidity, when you've got monetary debasement, when central banks are printing lots of money, house prices, which are clearly a hedge against monetary inflation, tend to go up a lot faster than incomes. So the house price income ratio goes up. What that means is that housing is really unaffordable to younger generations. I mean, all generations, but particularly younger generations. And if you can't afford housing, then you can't create families, and therefore the birth rates tend to fall off. And then you get labor shortage problems, and then the politicians say, well, okay, let's start getting more immigration into these economies to basically boost the workforce. And then you get a sort of a vicious circle downwards, because then you get essentially wages cut of existing workers, you get more and more social problems, et cetera, et cetera. And you end up with sort of low-wage economies, very low productivity, low-wage economies. Welcome to Europe.
What do you think about that?
Yeah, we talked to Felix and I were at a event in DC, and yeah, you can basically track this to household formation in the U.S. It's the same thing everywhere, but maybe Europe and Japan are more advanced in their decline. But in the U.S., it's almost below 2 average household size, and we've never had a time where the first-time home buyers were this old in their late 30s. We've never had a time where 50% of young adults are supported financially by their parents, or over 1/3 of first-time home buyers' down payment is supplied by their parents. And it's basically this intergenerational wealth transfer that needs to occur, but doesn't fix the inequality. So while we're, market practitioners trying to determine and pattern recognize the best ways to financially profit off these trends and navigate the capital markets socially and politically, these are just more forms of kicking the can, and ultimately there will be repercussions. But in many cases, like any politician's tenure, if you kick the can long enough, it's not my problem.
Yeah, and the irony is, if you want to buy some real estate, residential real estate, buy it in China. Because if you think about what's going on, the real problem that the West have is basically retirement and aging populations. And so the Medicare cost of that is awesome. So that's what's forcing the fiscal deficits up and up, and why they've got to monetize. But China doesn't have that problem. China doesn't have a social security system. Everyone says it should do. But what it has is people tend to fall back on real estate. So they basically put their wealth in real estate, and that is ultimately their pension funds. Now, what we know in China is that that's underwater. So what they've got to do is if they want to protect society in terms of long-term welfare for retirement, they've got to get those real estate values up. And I would suggest that's maybe what they're thinking about right now with this big monetization. So ultimately, what you'd expect to see is, if the gold price goes up, you're going to get asset prices in China lifting off, and already the stock market is zooming.
Final question here, just as we wrap up, Michael. But in your sage wisdom compared to us two young bucks, I would just love to hear everything we talked about. How unique is this moment? Is this something that is a regular multi-decade cycle or thing, or is there something truly unique about today? This panic for the debasement trade chase that we're seeing in the world today. How unique is that?
I think it's very unique. Let me sort of put that in context. When I was at Salomon Brothers, sort of the Bible that everyone used to read was a book. This is one for if you can't get to sleep, read it. But it was called A History of Interest Rates by Sidney Homer. And what that looked at was 4,000 years of interest rate history. Nowhere in those pages do you ever read zero interest rates. So that is how unusual the current situation is, or the situation in the last 10 years has been. We've never had zero interest rates. And ultimately, the solution of governments to any crisis is basically to throw money at it and to cut interest rates as rapidly as they can. They can't raise taxation anymore. They can't really curtail government spending. So what they've got to do is effectively monetize. So this is a unique situation. It's not, just in my lifetime it's unusual. It's unusual in 4,000 years of history. But if you go back and look at those pages of 4,000 years, you'll see that in the Roman Empire, there was lots of debasement as well. And what you need is monetary inflation hedges, and gold and crypto are vehicles for monetary inflation hedging.
Beautiful.
In short, it's the reason there's only one currency that has persisted through time, and that's gold.
And maybe we'll get a second one now.
Yeah, we very well
Don't
could.
trust politicians.
All right, that's all the time we have. Michael, Quinn, really great to have you here. Thanks everybody for listening. Give them a round.
Thank you.
Yeah.